Imagine you're standing at a crossroads in history, not just a cyclical turn, but a fundamental shift in how markets value money, credit, and wealth itself. Today's global financial system, built on trust in credit, sovereign debt, and fiat currencies, is under pressure from forces that don't respect conventional expectations. We are living through a moment that feels familiar on the surface, but fundamentally different underneath. Many people are trying to understand today's markets using mental models that were built for a world that no longer exists. When that happens, confusion grows, risk is mispriced, and opportunities are missed. What we are seeing now is not just another cycle within the same system, it is a shift in the system itself. For a long time, markets were driven by a relatively simple dynamic: growth, moderate inflation, falling interest rates, and expanding credit. In that environment, financial assets performed well because the cost of money kept declining and leverage was rewarded. Investors learned to buy dips, trust central banks, and assume that liquidity would always be there when needed. Those lessons worked until the conditions that made them true began to reverse. Today, debt levels are historically high relative to income. Governments, corporations, and households have all become deeply dependent on cheap money. At the same time, interest rates have risen from near zero levels, increasing the cost of servicing that debt. This creates a fundamental tension. Policymakers want stability, but the tools they use to create stability can themselves create new imbalances. When you zoom out and look at history, this pattern repeats again and again. At the core of this paradigm shift is the changing nature of money and trust. Money works because people believe it will hold value over time. When debt grows faster than productivity, that belief is tested. Central banks are forced to choose between protecting the value of money and protecting the system built on that money. Often, they attempt to do both, and that's where volatility comes from. In these environments, traditional relationships between assets start to break down. Bonds no longer provide the protection they once did. Equities become more sensitive to policy decisions than to pure business fundamentals. Correlations rise when people expect diversification to work the most. This is usually the moment when investors realize they are all exposed to the same underlying risk, just expressed in different forms. That is why real assets begin to matter more during these transitions. Assets that are not someone else's liability behave differently when confidence in financial promises weakens. Historically, during periods of high debt, currency pressure, and geopolitical uncertainty, stores of value become more attractive not because they generate income, but because they preserve purchasing power. This is not about fear, it is about balance. A paradigm shift does not announce itself clearly. It reveals itself through stress points, unexpected inflation, rapid policy changes, currency volatility, and widening gaps between financial markets and the real economy. People often mistake these signals for temporary problems rather than symptoms of a deeper adjustment. But over time, the accumulation of these signals becomes impossible to ignore. What makes this phase especially challenging is speed. Information moves faster than ever, capital moves instantly, and reactions are amplified. Markets can reprice dramatically before narratives catch up. That is when investors feel shocked. Not because the outcome was unimaginable, but because they were positioned for a world that was already changing. The most effective way to navigate such periods is not prediction, but preparation. Understanding cause and effect relationships matters more than short-term forecasts. Diversification must be real, not superficial. Holding assets that respond differently to inflation, deflation, growth, and crisis is essential. This is how resilient portfolios are built, not by chasing what worked yesterday, but by balancing for what could happen tomorrow. History shows that paradigm shifts eventually create new opportunities and new winners, but they also expose weaknesses in thinking. Those who adapt early tend to preserve and grow their wealth. Those who cling to outdated assumptions are often forced to react under pressure. We are at a point where the rules are being rewritten, quietly but decisively. The markets are sending signals that the environment is changing faster than many expect. When that happens, it's not the loudest voices that matter, but the clearest thinkers. The goal is not to be alarmed, but to be aware, because awareness is what allows you to act rationally when others are driven by emotion. When you study markets over long periods of time, you begin to see that prices are not random. They are the result of underlying debt and credit dynamics that expand and contract in fairly consistent ways. What confuses most investors is that these dynamics can remain stable for years, even decades, and then change very quickly. When that happens, price behavior shifts sharply, often in ways that feel sudden and surprising, but in reality are the logical outcome of pressures that have been building beneath the surface. Credit is essentially a promise about the future. When someone lends money, they are trusting that future income will be sufficient to repay it. As long as income grows faster than debt, the system feels healthy. Asset prices rise, defaults remain low, and confidence reinforces itself. This is the upward phase of the cycle, where leverage is rewarded and risk appears manageable. But this phase always carries the seeds of its own reversal. Over time, debt tends to grow faster than income because borrowing pulls future spending into the present. At first, this boosts growth and asset prices, but eventually the burden of servicing that debt begins to constrain behavior. More income is directed toward interest and principal payments rather than productive investment or consumption. When this tipping point is reached, the same credit system that once supported higher prices begins to suppress them. What makes this especially important for markets is the role of interest rates. When rates are low, debt feels manageable even at high levels. But when rates rise, the cost of maintaining that debt increases quickly. This change does not affect all participants equally. Highly leveraged entities feel the pressure first, and their need to reduce risk can trigger forced selling. This is often the moment when price movements accelerate and correlations increase across markets. Central banks play a critical role in shaping these dynamics. By controlling short-term interest rates and influencing liquidity, they can extend the life of a debt cycle. However, they cannot eliminate the underlying constraints. When debt levels are already high, their policy choices become more difficult. Tightening too much risks financial stress and recession. Easing too much risks currency depreciation and inflation. Markets respond to these trade-offs rapidly, and prices adjust as expectations shift. One of the key misunderstandings investors have is assuming that past price behavior will continue under fundamentally different debt conditions. For example, bonds have historically provided stability during periods of economic weakness, but when debt is excessive and inflation pressures rise, bonds can lose that protective role. Similarly, equities can remain elevated longer than expected during credit expansion, only to reprice quickly when liquidity conditions change. Another important factor is confidence. Credit systems function smoothly as long as participants believe others will honor their obligations. When that belief weakens even slightly, behavior changes. Lenders become more cautious, risk premiums rise, and access to credit tightens. This feedback loop can turn a gradual slowdown into a sharp adjustment. Prices move not just because of fundamentals, but because of changing perceptions about risk and solvency. History shows that these transitions are rarely linear. They tend to occur in waves, with periods of calm followed by sudden stress. Investors often underestimate the speed at which conditions can deteriorate once confidence breaks. This is why market shocks feel so extreme. Positioning is built for stability right up until it is no longer justified. In such environments, assets tied closely to credit performance become more volatile. Companies dependent on refinancing, governments running persistent deficits, and financial instruments built on leverage are all sensitive to small changes in funding conditions. When credit tightens, the adjustment is swift because there is little margin for error. At the same time, assets that are less dependent on future promises behave differently. Their value is not anchored to someone else's ability to pay, but to their role as a store of purchasing power. As credit stress rises, the market's preference often shifts toward these forms of safety. This change in preference can drive sharp relative price movements, even if the broader economy has not yet fully weakened. The most important lesson is that debt and credit do not just influence economic growth, they shape market behavior itself. They determine how sensitive prices are to policy, how quickly sentiment can change, and how severe corrections can become. Ignoring these dynamics leaves investors exposed to moves that appear irrational, but are actually the predictable result of imbalance. Understanding this does not mean trying to time every turn in the cycle. It means recognizing where you are within it and positioning accordingly. When debt is low and credit is expanding responsibly, risk-taking is rewarded. When debt is high and credit conditions are tightening, preservation becomes more important than performance. Markets don't break because of a single event. They adjust because accumulated pressures reach a point where the system must rebalance. Debt and credit dynamics are the engine behind that process. When they shift, prices follow often sharply, and often faster than most people expect when you look at markets through the lens of risk rather than return. One reality becomes clear. Most financial assets are more similar than they appear. They are claims on future cash flows, priced in the same currency, and heavily influenced by the same economic forces. In normal times, these similarities are easy to overlook because growth and liquidity lift many assets at once. But when conditions change, those hidden connections surface, and diversification that once felt sufficient suddenly proves fragile. True diversification comes from holding assets that respond differently to the same environment. That is why assets with no direct tie to credit, earnings, or policy promises play such an important role. Gold, and by extension other precious metals, occupies a unique position in this respect. Its value is not derived from someone else's obligation to pay, nor is it dependent on economic expansion to justify its existence. It functions outside the traditional financial system, and that is precisely what gives it its diversifying power. Throughout history, periods of stability have encouraged investors to concentrate in productive assets. This makes sense when growth is strong, inflation is contained, and confidence in institutions is high. However, these periods often lead to overconfidence in paper wealth. As leverage builds and financial complexity increases, the system becomes more efficient but also more fragile. When stress emerges, the things that once appeared unproductive can become essential. Gold has maintained its role across very different monetary regimes because it is scarce, durable, and universally recognized. It does not promise income, but it does preserve purchasing power over long periods of time. That distinction matters most when real returns on financial assets are threatened by inflation, currency depreciation, or debt monetization. In those moments, the goal shifts from maximizing growth to maintaining balance. What often surprises investors is that gold's value becomes most apparent when correlations rise elsewhere. During market stress, assets that are assumed to be diversified often move together because they are responding to the same liquidity and confidence shocks. When that happens, portfolios built solely around stocks and bonds can experience losses simultaneously. Gold tends to behave differently because its price reflects trust in money itself rather than confidence in growth or policy. Another important aspect of gold as a diversifier is its relationship with real interest rates. When real rates are positive and stable, holding non-yielding assets feels less attractive. But when real rates fall, especially into negative territory, the opportunity cost of holding gold declines. In such environments, the market naturally reevaluates the value of assets that are not tied to future promises. This shift can occur gradually and then all at once. Precious metals also act as a hedge against extreme outcomes. While these outcomes may not be likely in any given year, their impact can be severe when they occur. Currency devaluation, fiscal stress, geopolitical conflict, and sudden changes in monetary policy all tend to expose vulnerabilities in financial systems. Gold does not eliminate risk, but it helps offset the types of risk that are otherwise difficult to hedge. Silver, while more volatile, shares some of these characteristics and adds an additional layer of diversification. Its dual role as both a monetary and industrial metal means it can respond to different forces at different times. This can lead to larger price swings, but it also allows silver to perform well in scenarios where industrial demand and monetary uncertainty overlap. In balanced portfolios, this volatility can be managed rather than feared. The mistake many investors make is viewing gold as a short-term trade rather than a structural component. Its purpose is not to outperform equities in strong bull markets, but to stabilize portfolios across full cycles. When included in appropriate proportions, it reduces overall volatility and drawdowns, improving risk-adjusted returns over time. This is the essence of intelligent diversification. As systems become more complex and debt burdens rise, the range of possible outcomes widens. In such environments, relying on a narrow set of assumptions becomes dangerous. Diversification is not about predicting which asset will perform best, but about preparing for scenarios that are difficult to predict. Gold contributes to that preparation by providing exposure to a different set of drivers than most financial assets. In the end, successful investing is less about being right in a single forecast and more about building resilience. Assets that have endured through many economic systems tend to do so for a reason. Gold's role as a core diversifier is not based on ideology or fear, but on centuries of observed behavior. When markets are calm, its presence may seem unnecessary. When markets are not, it often proves invaluable. When you strip markets down to their essentials, most price movements are expressions of confidence or the lack of it. Nowhere is this more visible than in the relationship between gold and currencies. Gold does not move simply because of supply and demand in the traditional sense. It moves because it reflects how people feel about the future purchasing power of money. When confidence in currency is strong, gold tends to be overlooked. When that confidence weakens, gold begins to speak more loudly. Currencies are promises. They are backed not by physical constraints, but by trust in institutions, policy discipline, and the belief that tomorrow's money will buy roughly what today's money does. For long periods, this trust can remain intact even as imbalances grow. Governments can run deficits, central banks can expand balance sheets, and markets can absorb it without immediate consequence. But trust is not infinite. It erodes gradually and then suddenly. Gold functions as a reference point outside the currency system. It has no national issuer, no credit risk, and no obligation attached to it. Because of that, its price becomes a kind of mirror. When currencies are managed prudently and real returns are attractive, that mirror reflects stability. When currencies are stretched by excessive debt, fiscal pressure, or aggressive monetary policy, the reflection changes. Gold rises not because it has changed, but because the measuring stick has. One of the most important drivers of this relationship is real interest rates. When people can earn a real return by holding cash or bonds, confidence in currency strengthens. The incentive to hold a non-yielding asset is lower, but when real returns turn negative, the logic flips. Holding currency guarantees a loss of purchasing power, while holding gold at least preserves it. Markets respond to this shift in incentives quickly, even if the broader public takes longer to notice. Another factor is the credibility of policymakers. Central banks are tasked with maintaining stability, but they operate within political and economic constraints. When debt levels are high, the choices become harder. Tightening policy to defend the currency can destabilize growth and financial markets. Easing policy to support the system can weaken the currency. Investors watch these trade-offs closely, and gold prices often adjust before official narratives change. Currency risk is not always obvious. It does not announce itself through crisis headlines alone. It can show up as gradual depreciation, rising inflation expectations, or increased volatility in foreign exchange markets. In these periods, gold tends to rise steadily rather than explosively. This is the market quietly repricing money, adjusting for a future that looks less certain than the past. What makes gold especially revealing is that it reflects global sentiment, not just local conditions. Because it is traded worldwide, its price incorporates a wide range of perspectives on monetary policy, geopolitical risk, and economic stability. When multiple currencies face similar pressures at the same time, gold's role as a neutral store of value becomes more prominent. It becomes a way to step outside the relative game of currency comparisons. History provides many examples of this dynamic. Periods of high inflation, currency debasement, or loss of fiscal discipline have consistently coincided with rising gold prices. This does not mean gold predicts exact outcomes, but it does signal discomfort. It tells you that a growing number of participants are seeking protection from the erosion of money's value. Importantly, gold does not require widespread panic to rise. It often moves higher well before fear becomes visible. Institutional investors, central banks, and long-term allocators tend to adjust gradually, shifting exposure in response to changing incentives. By the time currency risk becomes obvious to everyone, much of the price movement has already occurred. This is why gold is best understood as an indicator rather than a speculation. It provides information about the system. When gold is stable, it suggests confidence in monetary management. When it rises persistently, it suggests that confidence is being questioned. Ignoring that signal does not make the underlying issue disappear. In a world where debt is high and policy choices are constrained, currency risk becomes a central concern, even if it is not openly discussed. Gold reflects that reality in real time. It does not take sides, it does not make promises, and it does not depend on optimism. It simply responds to incentives and trust. Understanding gold in this way helps remove emotion from the discussion. It is not about fear of collapse or belief in disaster. It is about recognizing that money is a system built on confidence, and confidence is dynamic. When that confidence shifts, prices adjust. Gold's movement is the market's way of expressing that shift, quietly and continuously, long before it becomes part of the mainstream conversation when markets undergo structural change. Certain assets react in ways that can appear extreme or even unpredictable. Precious metals, particularly silver, are prime examples of this phenomenon. Their prices do not move solely because of industrial demand or jewelry consumption. They move because they are sensitive to broader shifts in credit, currency, and market sentiment. In stable periods, these assets may appear quiet and unremarkable, but when the underlying system starts to wobble, their movements can be exaggerated, a reflection of forces that are building beneath the surface. Silver occupies a unique position among precious metals because it serves both as a monetary asset and an industrial commodity. This duality exposes it to multiple currents at once. When economic growth is accelerating, industrial demand can lift silver independently of monetary trends. Conversely, when confidence in financial systems is tested, silver behaves more like gold, responding to shifts in trust, currency risk, and the search for stores of value. These overlapping influences can create volatility far greater than what is observed in gold, whose role is primarily as a store of value. One of the most important drivers of exaggerated moves is leverage. Financial systems today are deeply leveraged, and when confidence falters or liquidity tightens, the unwinding of positions can be rapid. Silver, being less liquid and smaller in market capitalization than gold, often experiences the brunt of these adjustments. Even modest reallocations by institutions, hedge funds, or large investors can produce outsized price swings. In essence, silver amplifies the signals of stress and opportunity in the market. Market psychology also plays a role. Investors tend to overreact when confronted with uncertainty, and assets that can serve multiple purposes, monetary, industrial, and speculative, are especially susceptible to sentiment-driven swings. A small shift in perception about the stability of currencies, inflation expectations, or fiscal policy can trigger rapid moves in silver. Those moves are often further magnified by derivative instruments and futures markets, where positions can be accumulated and unwound quickly, creating short-term spikes and troughs. Historical patterns support this behavior. During periods of high debt, currency pressure, or geopolitical tension, silver has frequently outperformed gold on a percentage basis, both upward and downward. This is not randomness. It is the natural outcome of a smaller, less liquid market responding simultaneously to economic fundamentals, investor positioning, and sentiment about broader financial risks. Understanding these dynamics is critical for anyone seeking to navigate changing markets. Another factor that contributes to exaggerated moves is the changing relationship between gold and silver, often expressed through the gold-silver ratio. When the ratio reaches extremes, it signals that one metal may be undervalued relative to the other. Traders, institutions, and even central banks pay attention to these signals, which can provoke rapid adjustments. These adjustments do not necessarily indicate a structural flaw in silver's value. Rather, they reflect the market's attempt to restore balance in response to shifting fundamentals. It is also important to recognize that precious metals are global assets. Silver is traded in multiple markets across currencies and by participants with varying objectives. This diversity means that price movements incorporate a wide range of information and sentiment. In stable periods, the aggregation of these views produces smooth pricing. In transitional periods, however, conflicting interpretations of risk, growth, and currency stability can lead to sharp, sometimes exaggerated price behavior. Exaggerated moves are not inherently negative. They provide information. They signal that market participants are adjusting their views in response to changing circumstances. For investors and institutions who understand the underlying causes, these moves create opportunity. Those who misinterpret them as purely speculative or irrational risk missing the broader message. The system is shifting, and the signals are embedded in asset prices. Silver's sensitivity to multiple forces also makes it an important tool for portfolio management. Its volatility can be harnessed to hedge against shifts in currency risk, inflation, or market stress. While it can produce short-term fluctuations, over longer periods it reflects real changes in investor sentiment and the balance of risk in the system. In this sense, exaggerated moves are not noise. They are a natural part of a dynamic market responding to structural change. Ultimately, Silver and other precious metals reveal the underlying state of markets in ways that equities, bonds, or cash cannot. They magnify emerging risks and opportunities, providing a clear signal of systemic stress or adjustment. Understanding why these moves occur and how they relate to debt, leverage, and confidence allows investors to position themselves more thoughtfully. Exaggerated moves are not random shocks. They are a mirror of the broader forces shaping the financial world, and ignoring them comes at a cost in closing. Understand this. Markets don't move because we wish they would, they move because underlying forces demand it. And when those forces change the economic landscape, they can shock even the most seasoned investors.